All right, so I'm going to do some example problems for Chapter 3 here, but if you have not watched the video for the Chapter 3 PowerPoint lecture, you should absolutely do that first, okay? So this is meant to be a follow-on from that. So remember, with tax planning, you have three general strategies. You have timing, you have shifting, and you have converting, okay? So it's really important when you start to work a problem, you need to know whether it's a timing problem, a shifting problem, or a converting problem, okay? If it's a timing problem, one of the questions is going to be this year or next, okay? So are we going to recognize income this year or next year? Are we going to recognize a deduction or an expense this year or next year? Okay, that is a timing issue. Shifting, we're talking about shifting income either based on jurisdiction, so that would be location, or to different entities, okay? Because remember that different types of entities have different tax rates, right? Individuals have a different tax rate structure than corporations do. And amongst individuals, different individuals have different tax rates. My kids have different tax rates than I have, okay? From a location perspective, different states have different tax situations. From a tax perspective, Missouri is a better tax advantage state than Illinois is, because Missouri's income tax rate and corporate tax rates are lower than the state of Illinois. Okay, so that's shifting. Converting, remember, looks at how do we get out of the ordinary tax rate structure into the preferential tax rate structure, because preferential tax rates, capital gains, dividends, or tax exempt items obviously have a lower tax rate than an ordinary tax item. Okay, so whenever you're presented with a problem from a tax planning perspective, you need to figure out whether you're talking about a timing issue, a shifting issue, or a converting issue. Okay, so that is our starting place. All of the timing problems are going to use present value as a concept, okay? And if you've taken a finance class or multiple finance classes, you're familiar with the concept of present value. What that means is $1 today is better than $1 tomorrow. $1 today is worth more to me than $1 tomorrow, right? So this is a chart right out of your book. You will have access to this on all of the exams, and I will post this on Canvas if it's not posted there already. I'll double check here in just a minute and make sure this is posted on Canvas, okay? And so this first column tells you how many years in the future you're looking at. So if we're talking about a tax planning problem for this class, typically we're talking about 1 year from now. And these percentages are not tax rates. These percentages are your after tax rate of return. Okay, so it's important to know those things. So for any timing problem that we have, you're going to need to use either this present value table to find the factor, or you can use a financial calculator. That's absolutely fine. Then we have to use this fabulous chart or our financial calculators to determine what our present value factor / impact is. Okay. We can go back to our fantastic present value chart, all right? And we know we're dealing with 1 year, okay? And remember, the problem told us that our after-tax rate of return was 12%. Okay, so this is our present value factor, 0.893. All right, so let's take a look at the first problem that we're going to talk through in this video, okay? And we already said that this is all about tax planning, and there are 3 different ways that you can tax plan, right? And so whenever you get a problem like this, you should read the problem, obviously. And as you're reading the problem, you need to decide, is this a timing issue? Is it a shifting issue, or is it a conversion or a converting issue? Okay, so let's see what we got. This problem and all of the problems that I talk about in here are problems that are posted in that Chapter 3 practice problems document that's on our Canvas page. All right, so we've got Manny. He's a calendar year taxpayer. He uses the cash method of accounting for his sole proprietorship. In late December, he performs $20,000 of legal services for a client. Manny typically requires his clients to pay bills immediately upon receipt. We're told that his marginal tax rate is 37% this year, and it's going to be the same next year. That's important. And that he can earn an after-tax rate of return of 12% on his investments. So here is the question. Should he send his client the bill in December or January? So December is this year. January is next year. All right. So whenever you have an issue of, is it better to do it this year or next year? We are talking about timing. All right. And if we're talking about timing, then we care about present value. And if we care about present value, now, once you've recognized that it's timing, that's fantastic. But the other thing that you have to figure out is, are we talking about income? When do I recognize income? Or are we talking about when do I recognize an expense or a deduction? Okay, so I'm going to resize this a little bit, and we're going to talk our way through that. Okay, so let's look at the problem. Manny, blah, blah, blah. He performed $20,000 of legal services. All right, so he performed a service, and he's looking to get paid. All right, so that $20,000 is income, all right? And that's important to us because remember, income is fantastic, right? We all like income. Income is great. But what does income also do? Income raises our taxes because there is a tax cost of income, all right? So what do we want to do when we're talking about deciding whether we recognize income this year or next year? Well, if we're talking about income, we want to make sure we minimize our present value of tax cost. And by doing that, we're going to maximize our after-tax income, okay? So one of the cool things about tax planning is that, remember, the income we earn this year, we don't pay taxes on until next year, right? So by delaying the recognition of income from December to January, we delay that tax liability by an entire year. So tax planning is really a fantastic opportunity when you think of time value of money, okay? So let's get down to it. So what you're going to do for each of these timing issues is you're going to run the scenario for this year, and then you're going to run the scenario for next year, and you're going to look at them and see which one ends up with a better result, okay? So let's look at December. All right. So if he sends that bill in December and he gets his $20,000 of income in December, I'm going to move this up a little bit. In December, he gets $20,000 pre-tax income. So the present value of tax cost is going to be that $20,000 times his marginal tax rate, and we were told his marginal tax rate was 37%, okay? So what does that make our present value of tax cost? That means our present value of tax cost is $7,400, okay? Our after tax income, I'm going to move up again, is equal to our pre-tax income minus the taxes we pay. So our after-tax income is $12,600, okay? That's great. Wonderful. We still don't know the answer to our question. So we need to run that same scenario, essentially, for next year, okay? So I'm going to switch colors, and we can do January in green. All right, so in January, what will we have? Well, if we recognize that income in January, we'll have $20,000 still of pre-tax income, okay? Now, we need to find the present value of tax cost, okay? So we start out the same way. 20,000 times 0.37 equals 7,400. But, all right, but we need to look at this 7,400 now, because what is this 7,400, okay? This 7,400 is the present value of tax cost. This 7,400, because we're talking about January and we're talking about tax cost next year, is the tax cost 1 year from now. All right? So that $7,400 is not the present value of tax cost. So we still have to find the present value of tax cost. So the way we do that is we take that $7,400 and we find the present value of it 1 year out. Okay, so you can do that with a financial calculator, or, so we come back over here, we multiply that 7,400 by 0.893, all right? And that is going to give us our present value of tax cost, okay? And so that is $6,608, okay? So now, what can we do? We can look at our present value of tax for the January scenario and the present value of tax for the December scenario, and we can see that this present value of tax is much less than the December present value of tax, okay? But let's also look at after-tax income. All right, so our after-tax income is 20,000 minus 6,608, which is equal to 13,392, okay? So this is, I should keep with my same color here. After-tax January. This is after-tax December, okay? So remember, we're talking about income. what do we want? We want to maximize our after-tax income, all right? Since we want to maximize our after-tax income, we are going to want that amount of after-tax income. So we are going to want to whoops, don't do that. So we are going to want to recognize income in January. So send invoice in January, okay? And that makes sense, okay? Because remember, the general case, if our tax rate is the same 1 year to the next, and our rate of return is the same 1 year to the next, we want to defer income, okay? Now, we're going to see that is dependent on tax rates and rates of return, okay? But the default mindset should be recognize deductions now, defer income until later. All right, so let's work on the next problem. All right, so here's another problem from your practice set, okay? And this time we've got Hank. All right, and Hank is a calendar year taxpayer, uses the cash method of accounting for his sole proprietorship. In late December, he performed $20,000 of legal services. So performed services for a client. He typically requires his client to pay his bills immediately upon receipt. Assume his marginal tax rate is 32% this year and 37% next year. And that again, he can earn an after-tax rate of return of 12%. So the question is, in this problem, again, should he send the client the bill in December or January? Okay, so you have the same initial questions that you should be asking yourself. What type of tax planning are we talking about? All right. And this is, again, are we talking December? Or are we talking January? Is it this year, next year? So we're talking about timing for starters, all right? And then we also have to ask ourselves, are we looking at income and the effects of recognizing income, or are we looking at expenses and deductions, okay? And again, Hank performs services, so we're looking at income, okay? So this problem, the setup and the thought process is very similar to the problem we just did with Manny, okay? So now we have to look at this year versus next year. So we're going to set up the same scenario and horse race December against January, all right? So I'm going to scoot things up a bit. Okay, so let's look at December. And remember, he had $20,000 of pre-tax income. His tax rate is 32. So let's pay attention here. His marginal tax rate this year is 32%, okay? And his marginal tax rate next year is 37%. So make sure here in December that to find our present value of tax cost, we take our 20,000 times 32%, okay? And that gives us $6,400, and that is our present value of tax cost. So our after-tax income is going to be 20,000 minus 6,400, which is 13,600. All right? Same process as the last problem. Okay, so now we need to look at January. All right, $20,000 of pre-tax income. All right, and again, we need to find the present value of tax cost. So we need to look at that $20,000 times this year's tax rate. And remember, this year's tax rate is 37%. So the tax rate that following year is increasing. So that's going to be $7,400 of taxes associated with that $20,000 of income. But remember, this right here is not the present value of tax cost. This is tax cost 1 year from now. Okay, so we still have to find the present value of tax cost. So to find the present value of tax cost, is that tax cost a year from now times our present value factor. And remember, his rate of return is still expected to be 12%. So we get to use that same present value factor from the last problem. And that means that 6608 is our present value of tax cost. So our after-tax income is $13,392. Okay? So now we've done all of this great stuff, but we still haven't answered the question, because the question is, does Hank want to send that bill to his client in December or in January? So when would he rather recognize that income? All right. And so what we have to do, again, look at our after-tax income amounts. All right. If it's December, our after-tax income amount is $13,600. If it's January, our after-tax income amount is $13,392. So now in this situation, we should send the bill and recognize income in December. All right. And the reason for that is our tax rate goes up from 32% to 37%. And that was a big enough increase in tax rates to make it detrimental to us to defer our income. If tax rates are increasing at high enough amounts, you should absolutely recognize income when the tax rate is lower. But what you have to do is you have to do the math and see if your rate of return is enough to overcome that increase in tax rates. Okay, so this is a situation where you actually do what is not the default situation, and you recognize income immediately. All right, so let's do another problem. All right, so in this problem, we have Reese, and Reese is a calendar year taxpayer who uses the cash method of accounting for her sole proprietorship. In late December, she received a $20,000 bill from her accountant for consulting services related to her small business. She can pay the $20,000 anytime before January 30th of next year without penalty. So we're going to assume her marginal tax rate is 32% this year and will be 37% next year, and that she can earn an after-tax rate of return of 12%. When should she pay the bill? Should she pay it this year in December or next year in January? Okay, so again, whenever you get one of these problems, you have to ask yourself, what type of tax planning are we doing, right? And again, we've got a this year versus next year question. So this is also timing. And then if it's timing, you have to ask yourself, okay, so am I trying to figure out when I recognize income or when I recognize an expense or a deduction? And it says right here that she can pay that $20,000. So that lets us know that this is an expense, which is going to be deductible from a business perspective, okay? So now we've got to figure out December versus January. And so we set this up the same way we've been setting up problems. Also, pay attention. Remember that this is a 32% this year and a 37% next year, and we have a 12% rate of return on our investments. Okay? So I'm going to change colors here, and let's look at December. Okay. So now that we have decided this is an expense or a deduction, we're not concerned with after-tax with tax cost. We want to talk about savings, okay? So what is the cost of these services? The cost of the services is $20,000, okay? So we also need to figure out now the present value of tax savings, because remember, deductions bring us tax savings. So what is our present value of tax savings? So that's going to be our $20,000 times this year's tax rate, which was 32%. So our present value of tax savings is $6,400. So what is our after-tax cost of the expense? Well, that's going to be $20,000 minus our tax savings, which is going to give us $13,600. And this is our after-tax cost. Okay? All right, so remember, the calculation that we did is the same, right? It's the same 32% tax rate. That's no big deal. But the way we look at it is a little bit different, because now we're not talking about income. We're talking about a cost. We're talking about a deduction. So it actually brings us some tax savings. So let's look at the situation if we pay that bill in January. All right. And again, it's $20,000. And we need to find the present value of tax savings, just like we did before. Okay, so we're going to take our $20,000, times our this year's tax rate, which is 37%. And so that's going to give us $7,400 of tax savings in 1 year. Okay, so again, we have to find the present value of tax savings, and so that's 7,400 times our present value factor, and again, we're dealing with 12%, so our present value factor is 0.893. And so then our present value of tax savings is $6,608. Okay, that's our present value of tax savings. So now what is our after-tax cost if we pay that bill in January? So we take our pre-tax cost minus our present value of tax savings, and our after-tax cost is $13,392. So this is now our January after-tax cost. Okay, so we've done all of this math, which is fantastic. It's great. It's wonderful that we know how to do that. But now the question is, do we pay that bill in December or do we pay that bill in January? And so what we need to do is, because we're talking about expenses or deductions, we want the lowest after tax cost. All right. With income, we want the highest after tax income, right? But with expenses, we want the lowest after tax cost. So which one of these, December or January, is going to give us the lowest after tax cost? Well, after tax cost there is $13,600. After tax cost here is $13,392. So our lowest after tax cost is right there in January. So we would pay the bill in January. Okay, so that's the difference between an income problem versus a deduction problem. The calculations, the process is identical, but the way you look at that after-tax amount is very different. All right, let's go on to the next one. All right, so this is the last problem I'm going to do on this video. In the PowerPoint with the Chapter 3 practice problems, there are also some shifting examples. I will do those in class. So right now, let's do a conversion example, okay? So there's one like this in the PowerPoint video that I posted previously, the lecture video as well, but I thought it would make sense to do another one. So in this situation, what do we have? Well, we've got Martha Stewart, and she's got 3 different investment opportunities, okay? And so one of those investment opportunities is a high dividend stock, and it pays 7.3% dividend annually, no appreciation potential, okay? You've got taxable corporate bonds that pay an 8% annual rate, and then you have a tax-exempt municipal bond that pays a 5% annual rate, okay? So essentially what we're going to do is we're going to horse race these 3 investment opportunities, and we're going to decide, based on Martha's tax situation, which one is most advantageous for her, okay? And pay attention, we're given tax rates down here. So dividends are taxed at 20% for her, and ordinary income is taxed at 37%, okay? So what we need to do is we need to figure out the after-tax rate of return on each investment. So we need to compare okay, so that's what we're going to do. We're going to compare rates of return on investments. Now, for me, when I do a problem like this, I always start with the tax-exempt bond. Why? It's just the cleanest to do first. Okay, so I'm going to resize things. All right. Remember that the formula we're going to use for all of these is that fantastic tax formula, my favorite tax formula. Okay. So, oops, and I should have said after tax equals pre-tax times 1 minus the tax rate. All right. So let's do our tax-exempt municipal bond first, okay? Remember that whenever we are given this interest rate, okay, that is our pre-tax rate, okay? So equals pre-tax, so that's 0.05 times 1 minus, now, we need to know what our tax rate is on a municipal bond. What is our tax rate on a municipal bond? 0, right? Because they're tax exempt. So we really don't need to do this formula, do we? Because after tax rate of return just equals our pre-tax rate of return because it's a municipal bond. So for the municipal bond, our after-tax rate of return okay, so our municipal bond after-tax rate of return is 5%. Okay, so that's the municipal bond. Well, we might as well do this taxable corporate bond next. Okay, so the taxable corporate bond pays 8% annually. All right, that's great. And our marginal tax rate on ordinary income is 37%. Okay, that's very important. A taxable bond, a taxable corporate bond, is going to give us interest. All right, interest is taxed at ordinary rates when it comes from a taxable corporate bond. Okay, so I'm going to resize and come down here. Same formula. Except now we have some different numbers, right? So we're looking for our after-tax rate of return. Our pre-tax rate of return was 8%. Our tax rate on ordinary income was given to us as 37%. So now we need to find out what our after-tax rate of return is. And so our after-tax rate of return is 0.0504 or 5.04% for the corporate bond. Okay? So that is our after-tax rate of return for the taxable corporate bond. Okay? So now let's go back up and let's get the details from the third one. So now we have a high dividend stock. It pays 7.3% in dividends annually, no appreciation potential. Remember that dividends are taxed at 20%. Okay? So now let's take a look. All right, so now we've got the high dividend stock, and we still need to find after tax, and we're using the same formula. All right, I got to go back up and remember what percent rate of return, okay? All right, so now we fill in everything we know. We don't know after tax because that's what we're looking for. Pre-tax, 0.073, right, 7.3%. Our tax rate was given to us as 20% on dividends. So now we have to find out so our after-tax rate of return on the high dividend stock is 5.84%. Okay? So if we are looking at these three investments, all right, I'm going to make this a little bit smaller, but hopefully y'all can still see it on your screens. We have a 5% rate of return on the municipal bond. We have a 5.04% rate of return after tax. All of these are after tax rates of return on the corporate bond. And then we have a 5.84% after tax rate of return on the high dividend stock. So if Martha has to choose between these investments, risk is all the same, right? No preference for either type of investment other than rate of return, after tax rate of return, that is. Martha should choose the high dividend stock. Okay, so that is how you choose between different investments. All right, that is the end of this video.